and bridging the divide in his transition. We'll have more highlights from that conversation later in the show. Let's get and bridging the divide in his transition. We'll have more highlights from that conversation later in the show. Let's get you started with a look at where the major indexes stand as we head towards the close. Abigail Doolittle is standing by with On Record Watch.
Yeah, absolutely, Scarlett. What a rally we have here for U.S. stocks. And what a turnaround, too. The three major averages opened slightly lower. Now we're looking at stocks absolutely surging. The Dow and the S&P 500, both at record highs. The NASDAQ not far from a record close. And the Dow Transports putting in its first record close, or on pace for its first record close since December of 2014. Now, what could be behind some of this turnaround? The ECB tomorrow, the policy meeting. We did have a big rally in Europe and Asia. Some investors are expecting the ECB to extend its bond buying program, which would support some extra liquidity. As for one sector that's not participating, not trading higher, as you had mentioned, biotech. We have the biotech index down nearly 2% after Donald Trump did earlier indicate in an interview that he's an opponent to high drug prices. In fact, he said, quote, "I'm going to bring down drug prices." We also see, though, that biotech is off the lows. This could reflect two things. First, the fact that this could be perceived as an empty threat. This, according to Bloomberg intelligence analyst itich Wardana. Second, the Trump administration did indicate that they are considering Peter Thiel associate Jim O'Neill for the head of the FDA. Back in 2014, Jim O'Neill did say that he is a proponent of, quote, progressive approval, basically a different methodology at the FDA that could bring down prices naturally. So perhaps of a less pain to the drug makers, and perhaps helping to explain why biotech is recovering a little bit today, but still down at a 1-month low. And in fact, the biotech bear market continues. When we go into the Bloomberg and we take a look at BTV 4667, this is a chart of biotech in blue going all the way back to its record peak in July of 2015, down 35%, a big bear market. In white, we have the NASDAQ, a big divergence between the two. The NASDAQ is up 7% this year. The biotech index is down more than 20% on the year. Now, the gamey biotech index, higher risk, could be a tell that there could be some weakness ahead for the NASDAQ. And interestingly, we do have the NASDAQ in what's typically a bearish consolidation pattern there, marked in orange, a different version of the one back here earlier this year that brought pullback. So again, the biotech index, if this weakness continues, could be some kind of a signal ahead of broader market weakness to come.
All right. Thank you so much, Abigail Doolittle.
What'd you miss? In a rare behind-the-scenes look, Bloomberg obtained access to some of the private forecasts and deliberations of Federal Reserve staff members at the center of the storm. Here with some key takeaways, Bloomberg economics reporter Matthew Boesler. Matt, fantastic scoop with your colleague Carlos Torres. Craig Torres. So this was 2010 memo internal at the New York Fed deliberating how to, how they saw the economy unfolding and how best to combat this sort of ongoing malaise. What did you learn in this memo?
Yeah, that's right. So each of the 12 reserve banks that make up the Fed system around the country, they all have economists and analysts on staff who prepare these briefings for the presidents of the reserve banks for them to then take into the FOMC meetings and sort of be able to speak intelligently and decide what to do. And so basically what we learned in these briefings from the New York Fed was very interesting because they're sort of the Fed's eyes and ears on Wall Street, right? And 2010 was a very tumultuous time in the markets and the economy. So at the beginning of the year, it was really interesting because they were really worried about high inflation, runaway inflation from, potential, all of the excess reserves they pumped into the system. And there were concerns in the markets that, we weren't really
These were new tools at the time. No one really knew what the ramifications of QE were going to be, and there were a lot of people who thought that it was sort of money printing that would lead to hyperinflation.
Yeah, that's exactly right. And then it was a very interesting year because then throughout the course of the year, you saw the Greek debt crisis flare up, right. And then we kind of had the opposite concern where they became more worried about deflation, and that led to some more radical sort of policy proposals. I actually brought you guys a chart that I think illustrates this really well.
I have it right here, actually. Yep. And it's a cost protect against inflation above 4% for 5 years. That is your white line. The blue line here, and this is the one that you circled, is a cost protect against deflation for 5 years.
That's right. So you can see at the beginning there of 2010, which 2010 is, denoted by those vertical red bars, we were really concerned about high inflation, like I was just saying. That's the white line. And then you can see that throughout the course of the year, deflation became a much more concerning thing. And that was September 2010, where we have that circle.
It's interesting if you unzoom there, though, how at the time people were simultaneously concerned about very high inflation and deflation because both of them trended lower. But at the time, it seemed like we were sort of, stuck between two awful situations. We just didn't know which one was going to be.
Exactly. And so you really have this full arc of them coming full circle. And it's interesting because at the time in September 2010, when those deflation fears kind of hit their peak, basically what the New York Fed staff said was, we should tie what we do with the balance sheet to future movements in inflation. That's kind of a precursor to the Evans rule that the Fed eventually went with in late 2012, nearly 2 years later. That kind of was the open-ended QE.
Or that was what their recommendation was.
Right, and so they obviously didn't end up doing that year, but then 2 years later when you got to QE3, that's exactly what they did. And so a lot of Fed officials now, when they talk about going forward, the next time we have a downturn, what they want to do is be less conservative at the outset and really kind of, go full stimulus at the beginning.
Mario Draghi was credited with doing whatever it takes, with his vow to do whatever it takes to save the euro. But what we've learned from these documents is that the Fed got there as well, albeit a little bit more slowly, this idea that they would do whatever it takes to meet their dual mandate.
Yeah, so Draghi, I believe, said that in July 2012. And then you had the Fed come out with open-ended QE a few months later in September 2012.
But the seeds were planted earlier than that.
That's right. So this goes all the way back 2 years before. And another thing that they were proposing, which still has not been taken up by the Fed, is something called price level targeting. And so members of the FOMC, some of the Reserve Bank presidents talk like this. Like you'll hear them in their speeches this year saying, well, if our inflation target is 2%, we should really be averaging 2% over time. If we're spending time below it, we should be spending time above it as well. And that's exactly this proposal that the New York Fed was suggesting, staff were suggesting in 2010, ultimately wasn't taken up. Interestingly, one of the big opponents of it was Janet Yellen herself. She had reservations that it would be too confusing or too difficult for the public to understand and to implement. And you also had concerns about inflation at the time, like the chart showed. So I think there was, again, that sort of conservative element that ultimately kind of predominated.
And the New York Fed was behind this. It was Bill Dudley who runs the New York Fed. Talk a little bit about how influential the New York Fed is versus the other regional banks.
So the New York Fed sits sort of at the center of financial markets and the banking system here in New York. Obviously, it's a major financial center. And so they have insight into the markets that the other
area right on is saying, hey, look, regulations are going to change here. It's going to be a new world here for you. So don't leave so quickly. And this is why these regulatory agencies, some are okay. And I'm not saying every regulation shouldn't be made. And there are good regulations and you need them. But they've gone, in many cases, almost insane. And what Donald is trying to say is, don't leave our country. We're going to get rid of a lot of these regulations. I mean, like I keep going back again, I guess, to this crazy obligated rule. They should change that immediately, if possible. So how do you obligate somebody to do something that they can't do? So, yeah, I'm saying that as far as I'm concerned, Donald is coming in and saying we must get jobs back in this country, good jobs.
I hear you on that.
That the regime is over. So I think with Kerry and all that, I think he's really saying to him, hey, look, don't leave this country. Stay here. We're going to help you with regulations. We're going to help you every way we can. I don't want you to leave, okay?
That might be the case, Carl, but is he picking winners and losers?
I think, who did he pick? He's just telling, he's telling Kerry, don't leave the country. I mean, he's not picking anybody.
That was Carl Icahn, Icahn Enterprises chairman, in an exclusive interview with Bloomberg Television.
Up next, the UN declining to an 8-year low and China takes action. We show you how next. This is Bloomberg. That happened earlier this week, which was that there was this huge surge of money into ETFs that were sort of short duration ETFs. Basically, everyone coming out of long bonds and long treasuries into things that were very unsensitive to rates. Tell us what you saw.
Exactly. So on Monday, the top 5 inflows into bond ETFs were all things like the main thing they had in common was that they either like held floating rate bonds, variable rate, or very short rate corporate debt, junk debt, or just, sovereign debt, plain old vanilla. So, and the biggest outflows the same day was Vanguard's long-term bond fund, which, most of those things mature after 2040. So what this really tells us is that, in September, I was talking to Kathy Jones at Charles Schwab. She said, duration risk, that's the one thing my clients don't ask me about anymore. Everybody thinks lower for longer is lower forever. And now that's the one thing everybody's worried about.
This is the chart Scarlett brought up on her terminal, hashtag BTV2977 for those who have a Bloomberg. So that huge spike, what are some of these near float, SJNK, what are some of these ETFs?
So that's the iShares short maturity bond ETF, floating rate bond ETF, Barclays short-term debt. So some of them, are safe havens, but others, you're still taking on default risk. This is still corporate debt we're talking in other places.
The common thread is that they're protection against a rise in rates.
Yes, protection or at least less vulnerable.
So forgive the obvious question here, but when we talk about duration, it's more than just seeking out 10-year or 30-year securities, isn't it?
Yes, exactly. So almost what I was just mentioning. So the kind of bonds that you'd think would be most sensitive or have the most duration risk are things like long-term sovereign debt in safe nations, U.S., Swiss, Germany, because so much of it, there's very little default risk associated with those. Yet over the life of the bond, there's a lot of sensitivity to fluctuations in interest rates affecting the price.
It's just funny that you would have duration being measured as interest rate risk when you're investing in fixed income. Like, how can you strip that out?
Exactly. It's, there's different components of it as opposed to default risk in corporate bonds. That would be the easiest differentiator.
And so today, in the action that we've been talking about today, one of the things that makes it really remarkable is that rates have really come in. We've sort of got one of these everything rallies, the likes of which we haven't in a while. And you could look at a chart like that and you might say that might have been a tell that on Monday, this is Monday, I think that we saw that huge flow, that on Monday there was this huge flow into assets that were avoided risk of duration, and then we get the huge duration rally today.
I think Scarlett was almost onto it perfectly earlier when she was talking about Mario Draghi and the ECB having the potential to kind of crush and bring in risk premia. We know we had the Fed crushing risk premia, then they handed it over to the ECB, BOJ. U.S. fiscal policy expectations kind of reversed that, but now we have the potential tomorrow for central banks to kind of grab the narrative again.
Now, there have been duration rotations in the past, right? Over the last 5 years, we've seen this before, but they never really panned out. What's different this time?
I think the thing that's most different this time is I was earlier today just at Bank of America's year-ahead outlook, and the baton seems to have been passed more fully to fiscal policy, a lever that has a lot more room to work, and kind of I'd say the expectation that inflation is rising, data is firming, seems to be much more entrenched. You have signposts like expect to see soon, and that's something that if you look at Canada, Trudeau's infrastructure spending hasn't really showed up yet at all.
Another obvious question, where does this duration rotation leave munis, for instance?
That's, unless that's tough to tell, I wouldn't be able to offer any kind of intelligent comment on that.
Are they low duration or high duration products, or it depends?
Well, they have more kind of credit risk built into them than say your U.S. Treasury.
True.
It's along the scale.
All right, you can always find something that matches your risk profile.
All right, follow Luke's stuff for a great tracking of these ETF flows, because sometimes they pick up really interesting turns like that. Bloomberg's Luke Kawa, thank you very much for joining us.
All right, let's just get a recap here of what happened in equities today. The Dow and the S&P closing at their all-time highs. We also had the Dow Transport closing at its best as well. You had 10 out of 11 sectors in the S&P 500 finishing in the green. The lone exception there was healthcare companies, and it came after Donald Trump indicated that he does not favor high drug prices. He wants to bring those drug prices down.
Coming up on Bloomberg, we look ahead to 2017's economic road with Michelle Meyer, head of economics at Bank of America Merrill Lynch, who will give us her outlook. This is Bloomberg.
I'm Nina Melendez. Let's get to First Word News this afternoon. President-elect Donald Trump has nominated Iowa Governor Terry Branstad as U.S. ambassador to China. He's a longtime friend of President Xi Jinping. Chinese Foreign Minister spokesman Liu Kang called Branstad an old friend of the nation's. Branstad and Xi met when China's leader made his first trip to Iowa in 1985 during a sister state exchange. President-elect Donald Trump says that Mitt Romney is still in the running to be Secretary of State. Trump said he and the 2012 Republican presidential nominee have come a long way together, despite Romney's harsh criticism of Trump. The president-elect told NBC he'll be announcing his choice soon.
I think next week will be the time that I announce it, and I have some other big announcements coming up today and actually tomorrow. But we've been met with, really very good reviews of the people that I've chosen.
Meanwhile, Trump has been named Time Magazine's Person of the Year. Time says it gives the title to the person who has had the greatest influence on events, for better or worse. National investigators say the driver of a Baltimore school bus that smashed into a transit bus last month was speeding and had a history of crashes and seizures. The accident killed 6 people. The National Transportation Safety Board said the driver was going nearly twice the speed limit when he struck a Ford Mustang from behind, then struck the transit bus. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Nina Melendez. This is Bloomberg.
Thanks so much, Nina. We also have some breaking news here. According to Reuters, Donald Trump has chosen Linda McMahon for his Small Business Administration head. So Linda McMahon, who, of course, married to Vince McMahon, was known for developing World Wrestling Entertainment. She is a wrestling magnate. She's also a former Republican Party candidate. She has been, according to Reuters, chosen as Donald Trump's Small Business Administration head. We'll continue to monitor these headlines for you. What'd you miss? 2016 has given us Brexit, President-elect Donald Trump, and a cautious Fed that'll end up raising rates only once this year. We have seen unusual events, including the expansion of negative interest rates and an OPEC agreement to cut oil production. 2017 is expected to be just as volatile, with Trump taking office, an unsettled Europe, and lingering concerns on China. Here with us now to discuss how she sees next year taking shape is Michelle Meyer. She's head of U.S. economics at Bank of America Merrill Lynch. And Michelle, when you are formulating your 2017 outlook, the headline that caught my eye was that you see only one Fed rate increase in 2017. It won't even come until the second half. What's going on there?
Yeah, so that is a bit unusual. It's out of the consensus, I would say. And I think the reason for it is that Janet Yellen will still be the head of the FOMC. I think she's still going to be embracing a pretty cautious attitude towards the hiking cycle, still thinking about a normalization process. And I think in terms of what will change in the medium term, the big story is fiscal stimulus. But the fiscal stimulus is unlikely to kick in until some point in the end of 2017. And really, it's a big story for 2018. So when you think about the first half of next year, you're supposed to think about, kind of that same economy that we had previously, that we've had this year. You're supposed to still think about, the relationship with interest rates and the dollar. The dollar has strengthened. Interest rates have increased, which is some tightness in that respect. Mm-hmm. So my view is that the first half of the year is a little bit softer in terms of growth. Yellen will remain cautious. Into the second half of the year, we start to see fiscal stimulus kick in, growth accelerates, and that allows for Yellen to ramp up the hiking cycle.
It is pretty remarkable the degree to which markets are repricing things like inflation, long-term interest rates, and so forth. We talk a lot about since the election, but it really started in the middle of July, the rise in rates. Has the market gotten ahead of itself? Is it now sort of in line with where fundamentals should be, or would dictate that things should be? What do you think is the story of what's really going on here?
Yeah, so that's a really good point that I think people kind of forget, is that a lot of this was moving in advance of the election, particularly around inflation and inflation expectations. They were starting to shift higher. The market was starting to get a sniff of the idea that we're moving from a disinflationary environment to one where we can start to see some inflation. So in my view, the move, particularly inflation, has kind of been a reset to levels that are more appropriate. I think the question going forward, and you can see from this chart, is, our forecast for core PCE inflation and headline inflation, we're going to get to 2%. Maybe by the end of next year, but certainly it seems like by 2018, and that's the Fed's target. So that's when I think this story really starts to change. You're at target. How much above target are we going to be able to see? How much above target does the Fed kind of allow in terms of that overshoot?
But there are different types of inflation. People call it good inflation, bad inflation. You've got asset price inflation, like in stocks, like in bonds. You've got wage inflation, and you've got price inflation. Yep. Is there an order in which it's supposed to appear?
Yeah. So, we've seen asset price inflation. And I think generally when you think about monetary stimulus, it will most directly feed into asset price inflation. And that was certainly the case in the environment of QE and effective lower bound interest rate policy. So we've seen that. We're still seeing that clearly. And then I think the question is, when do you start to see wage inflation and price inflation, which kind of have this nice feedback? And I think that we're on the cusp of that. We are now seeing this trend higher in underlying inflation. Wages are heading higher. The labor market is either at or very close to full employment with a 4.6% unemployment rate. So I think you're going to continue to see that story play out, where you have this relationship, this positive feedback between wages heading higher and underlying price inflation moving up too.
You mentioned earlier the strength in the dollar and the rising rates, both of those having the effect of tightening financial conditions a little bit. The dollar in particular could actually act as a dampening on inflation, particularly import inflation. How big of a factor are those financial, is that financial tightening going to be on the real economy?
Well, I think that, we can look at what happened in 2013 with the taper tantrum around rates. We can look at what happened in 2014 with, kind of a dollar tantrum. So both of those are good examples. And I think for interest rates, it's a little bit harder to quantify the impact. But for the dollar, we saw directly a widening out in the trade deficit, and we saw core consumer import prices fall, which by our models had led to a slowing in inflation. So I think depending on how much the dollar moves from here, you could have maybe a 5 to 10% appreciation pre-election through early next year, and that's significant. So I think one of the components in our forecast is that we do have a widening out of the trade deficit next year.
Productivity gains have been fairly elusive in this economic recovery. What's your confidence that Donald Trump's new infrastructure investment and spending could boost productivity?
So I think, and this is something that I found that Chair Yellen talked a little bit about in her testimony to Congress 2 weeks ago, is this idea that not all fiscal stimulus is the same. There's certain fiscal stimulus programs that enhance productivity and could boost potential growth, and there's others that kind of borrow from the future and create some sort of excess and boom. So I think you hit on something important, which is infrastructure spending. To me, an